Some say Ethereum is the future of finance, a decentralized platform for Web3 and DeFi. Others call it an overcomplicated bubble, a network burdened by scaling challenges and institutional wealth extraction. But whether you champion it or criticize it, Ethereum has fundamentally transformed what blockchain technology can achieve, from currency to programmable finance, from digital art to entire financial systems operating without intermediaries. Over the past decade, Ethereum's price has surged from cents to $4,191 in November 2023 and currently trades around $3,400 in late 2025. This trajectory has created extraordinary wealth and devastating losses. Ethereum has birthed a $140 billion ecosystem of decentralized finance protocols, generated overnight fortunes through yield farming and staking, and left behind countless stories of hacks and liquidation cascades. What forces orchestrate these dramatic market movements? In the dance between developers, Wall Street institutions, exchanges, and capital seekers, who truly wins? Today, let's reveal the mechanisms driving this far more complex machine than Bitcoin, one that blurs the line between innovation and extraction. The birth of Ethereum? Bitcoin solved one problem: decentralized currency beyond government control. Within 4 years, developers asked a bigger question. What if we could build programmable money? What if we could create an entire computer on a blockchain capable of executing any contract or application imaginable? In 2013, 19-year-old Vitalik Buterin published a white paper proposing Ethereum, a blockchain with a built-in programming language for smart contracts. Unlike Bitcoin's limited scripting, Ethereum would be a world computer, a Turing-complete platform where developers could create decentralized applications without intermediaries. On July 30th, 2015, Ethereum went live with 72 million ETH compared to Bitcoin's eventual 21 million, and crucially, no supply cap. This distinction fundamentally changed its economic properties. In early years, Ethereum was virtually worthless, but developers saw the vision. By 2017, an ICO frenzy pushed its price from $1 to over $1,400 in a single year. The pattern was set. Ethereum would be the platform where wealth would be created, concentrated, and harvested. The rise of DeFi and institutional entry. Unlike Bitcoin, which aspires to be digital gold, Ethereum became infrastructure for rebuilding traditional finance on decentralized rails. This crystallized around 2020 with decentralized finance, DeFi. Early DeFi protocols, Uniswap, Aave, Curve, created open-source financial primitives, exchanges without intermediaries, lending markets without banks, yield farming that promised extraordinary returns. For a moment, Ethereum appeared to deliver its founding promise: finance liberated from centralized gatekeepers. By January 2024, Ethereum's DeFi ecosystem held approximately $54 billion in total value locked, TVL. By January 2025, that surged to $129 billion, a 137% year-over-year increase. Ethereum commanded 55% of all DeFi TVL, approximately $71 billion, making it the undisputed center of decentralized finance. But institutional capital saw something different. They saw yield-generating infrastructure. Ethereum's transition to proof of stake, September 2022, created something unprecedented: a blockchain generating passive income through staking. Initial yields of 15-20% normalized to 3-5% by 2025, still attractive to institutions seeking higher returns than traditional finance. The true institutional breakthrough came May 23, 2024, when the SEC approved 8 spot Ethereum ETFs. By August 2025, these ETFs had attracted $22 billion in net inflows. BlackRock's Ethereum ETF alone achieved a record $1.02 billion single-day inflow, purchasing 150,000 ETH in one session, unprecedented institutional acquisition. The 3 layers of Ethereum capital control. Ethereum's wealth extraction operates through 3 distinct layers, each controlled by different actors. Layer 1, the staking cartel. By late 2025, approximately 35 to 37 million ETH, 29 to 31% of total supply, were staked, generating 3.13% annual yields through protocol rewards and MEV. Lido, the largest liquid staking protocol, controls 24.7% of all staked Ethereum, roughly 9 million ETH. While its market share declined from 32.3% in late 2023, it still commands nearly 1/4 of staking power. This reveals the fundamental truth. Ethereum's security and validation layer is increasingly concentrated. Layer 2, liquid staking and yield generation. Liquid staking protocols like Lido generate fees by taking a percentage of staking rewards while deploying staked ETH into DeFi protocols for additional returns. You could stake ETH, receive stETH in exchange, then deploy that token as collateral in Aave, Curve, or Compound, earning returns on multiple layers simultaneously. Layer 3, exchange and application infrastructure. Coinbase, Kraken, Lido, OpenSea, and thousands of other platforms control pricing, liquidity, user experience, and MEV. Coinbase commands 11.7% of staked Ethereum. Binance controls 8.4%. Together with Lido's 24.7%, these three entities control 44.8% of all Ethereum staking, the majority of Ethereum's security validation concentrated in 3 centralized platforms and 1 semi-decentralized protocol. The metamorphosis. From decentralization to institutional platform, Ethereum transformed its narrative from decentralization to productive infrastructure. Bitcoin faced tension between resisting institutional control and attracting institutional capital. Ethereum solved this differently. It became the infrastructure enabling institutional finance. DeFi reconstructed finance on decentralized rails. Staking replicated traditional yields on-chain. Layer 2 solutions reduced transaction costs by 94% after March 2024. Making Ethereum genuinely useful for real-world applications. The hidden leverage. Wealth extracted by Ethereum's institutional layer flows to a speculative layer of retail traders, DeFi farmers, and leveraged positions. Consider the mechanism. A retail user deposits ETH into Aave, earning 3 to 5% yields. They borrow stablecoins using ETH as 60-70% collateral, deploying borrowed funds into yield farming protocols chasing 10 to 20% returns, mathematically guaranteed to evaporate as more capital chases them. The user is now leveraged. When Ethereum's price moves 5 to 10%, leveraged DeFi positions face liquidation cascades. During 2025 corrections, billions in leveraged positions were wiped out in hours. Who liquidated them? Institutional arbitrageurs, market makers, and validators front-running transactions through MEV strategies. Protocol consolidation and developer control. Ethereum's technical leadership remains with Vitalik Buterin, but institutional control is increasingly visible. The network upgrade process has become corporate-driven. Exchanges, staking providers, venture capital firms, and institutional users now effectively control Ethereum's development roadmap through concentrated capital. Venture capital firms that funded early dApp projects now control governance tokens and board seats on Layer 2 protocols. Who truly wins? The real winners, BlackRock and asset management firms earning management fees regardless of market direction while capturing price appreciation. Corporate treasuries like Bitmine, 1.15 million ETH, and SharpLink, 740,000 ETH, that accumulated before institutional entry, earning staking yields indefinitely, early Ethereum developers and protocol builders capturing fees from billions in TVL. The losers, retail traders who bought at 4,191 in November 2023 and sold at $30,400 in 2025, realizing 30% losses. DeFi farmers who chased 20% yields, watching them collapse to 1 to 2% as institutional liquidity flooded the market. Small validators lacking economies of scale to compete with Lido, Coinbase, and Binance in a winner-take-most game. Ethereum's unresolved contradiction. Ethereum was designed as a world computer, a globally distributed, censorship-resistant platform for programmable finance. Yet it has become a wealth concentration machine. The protocol's innovation was enabling infinite financial innovation on a shared security layer, but financial innovation always initially distributes among small players before consolidating toward large institutions. In 2019-2020, retail users dominated DeFi. They were first movers in Uniswap, Aave, and Compound, earning extraordinary yields. But as protocols scaled and institutional capital entered, yields compressed, leverage became necessary, and institutional capital acquired controlling positions through governance tokens and capital deployment. By 2025, Ethereum remains technically revolutionary, genuinely censorship-resistant and programmable, but it is no longer decentralized in practice. Staking concentration, exchange consolidation, venture capital control, and corporate treasury accumulation have created a new form of finance, decentralized in appearance, centralized in power. The Pectra upgrade and future consolidation. In March 2025, Ethereum deployed the Pectra upgrade, including EIP 7251, allowing validators to manage larger stakes without running separate nodes. This removes friction for institutional validators to operate at enormous scale while raising barriers for small individual stakers lacking infrastructure. Each upgrade moves Ethereum further toward validator centralization. The staking thesis and its hidden risks. For institutions, Ethereum staking represents an ideal investment, assets generating 3-5% annual yields backed by essential DeFi infrastructure. But this thesis obscures critical risk. Ethereum has no supply cap. Unlike Bitcoin's fixed 21 million, ETH is continuously minted as staking rewards. Staking yields are mathematically a form of monetary inflation paid from dilution, not profit. As staking participation approached 30% by late 2025, the ratio had increased six-fold since 2023 from 5% to 30%, yet yields compressed 70% from 15% plus to 3 to 5%. As more capital chases yields compress. Future institutional stakers will earn lower yields bearing identical risks. Systematic wealth transfer from late entrants to early adopters. Final reflections, digital finance at the crossroads. Ethereum in 2025 stands at a crossroads. It achieved its technical vision, a platform for extraordinary financial innovation. But it failed its decentralization vision. Power has reconcentrated among a new technocracy of protocol developers, venture capital firms, and early capital that moved first. For those entering today, understand what you're participating in. You're entering a platform that attracts institutional control through productive yields and technical sophistication. The institutions that once feared Ethereum now position themselves as indispensable infrastructure operators within it. The DeFi revolution promising to disintermediate finance created new invisible intermediaries operating through code. The staking revolution promising distributed earning potential created new hierarchies of yield based on capital accumulation. Ethereum remains technically brilliant and financially offers genuine opportunities, but the narrative of liberation through decentralization has been replaced by the reality of efficiency through distributed infrastructure controlled by concentrated capital. For yield seekers, Ethereum staking and ETF participation offer 3 to 5% annual returns. But recognize, you earn this on the backs of leveraged retail traders whose liquidations fund your passive income. Your participation gradually centralizes Ethereum into an institutional financial layer that, while more efficient and profitable, resembles every traditional financial system it was designed to transcend. The future of Ethereum, whether it becomes a genuinely decentralized world computer or merely a more efficient version of traditional finance, remains unwritten. But if current trends continue, the answer is clear: it will be the latter.